All right, we're live. What's going on, my fellow business owners, entrepreneurs, real estate investors? Welcome to another episode from the Loan Assassin, where we give you all the tools, training, and resources you need to grow your business. We are doing another segment on real estate investing, so it's going to be really good for you real estate investors out there. We did a fantastic training last week, which I'll have linked in the description, on analyzing markets and real estate deals, just some of the most important numbers that you want to look for and look at to determine whether or not it's a good market and a good deal, right? Obviously, a really good foundation to have. But to take it a step further, we've got Jose back from BDA Solutions to break down. We're going to break down 3 real estate deals that his clients brought to him. Some of them that they got funded and are actually going through. So we're going to compare the difference between what a good real estate deal looks like and a bad real estate deal to give you some real life examples. Real numbers. These are real deals that Jose and his clients are working on right now, so that you can get a better grasp of what numbers to look at, and basically just getting better at identifying a good real estate deal. Right. So make sure you stick to the end. If you find the video helpful, one thing I ask, just hit that like button. Also consider if you'd like to potentially work with Jose and his team to help you grow your real estate business, get funding for your next deal, etc. Do an analysis of potential real estate deals that you have in the pipeline. We'll have a link in the description as well to book a free consultation with Jose and his team. Make sure you take advantage of that, especially if you're an active real estate investor. So with that said, Jose, once again, welcome, my friend. It's always a pleasure. How you doing?
Good, bro. How are you? I'm really
Doing good.
excited to kind of dig into these numbers a little bit and move out of the hypothesis and act to actual down and dirty. Let's roll up our sleeves and get
Right.
right into it and see if we can start to materialize some of these concepts for our listeners out there.
Yeah. So really, like I said, kind of expanding on last week's training where we have the information. That was really good. We got you provided some great info on and specific types of numbers and reports to get and stuff like that. But I agree, it's going to be really helpful for people to see how to actually take that information and what does it look like in a real deal. So we're actually going to have you share your screen. What are we starting with? Are we starting because you got 3 deals that we're going to break down. Is
Mhm.
this a good deal that we're going over, or is this a bad deal? The
So
first one.
this is a very good deal. And the reason that I say it's a very good deal is because there are 2 viable exit strategies for this particular project.
Okay.
This deal came to me from one of our Facebook leads. A gentleman reached out to me and basically brand new investor, had absolutely no experience, but his credit was great. Like he was a 700 plus credit score. So that kind of opens up the realm of possibilities for us to be able to facilitate financing when credit is on par. So this particular deal is in Corpus Christi, Texas. He had a 6-month project on it. His after repair value is $225,000. Now, this number we verified off of a BPO. The BPO
What you
that
talked about
his
last week.
realtor, correct. His BPO came in from the realtor. The realtor had, I believe, 4 actual closed properties in his area within 1 mile radius,
Hmm.
same square footage, same bed and bath count. So
Nice.
the number worked out really well. When I submitted it to the lender, our lender doesn't necessarily care about your credit score when it comes to securing a rehab deal,
Hmm.
um, because you are going to be selling the property on the back end. His exit strategy was strong, and they also felt much more comfortable uh, financing the deal because he was able to he was in a position to refinance it. So even if his ARV was slightly inflated, they were still going to lend on the deal because he can refinance out of the
Right.
15% interest.
Okay.
So it lined up really well. Anyway,
That's the
his
benefits of having
purchase
good credit.
price, awesome
Got to
benefit.
have good credit.
It definitely helps. And
Yep.
if you don't have it, we can help you get it. So yeah, it's definitely something to keep in the back of your mind. He purchased the property He had it under contract for $65,000. He had a $65,000 rehab budget on it.
Wow.
His closing costs were only going to be $7,500. And that had to do primarily with his title, his attorney fees, and insurance. He had to get property insurance. So those three line items are what make up his closing costs.
Okay.
His holding costs were going to be $22,500 over 6 months. That is the number a lot of real estate investors tend to overlook
Right.
when it comes to analyzing the profitability of your deal.
Right.
Where that number comes from on this spreadsheet that we use, for all of the deals that we come across, we always plug in into this spreadsheet to tell us whether or not it makes a good deal if it makes sense for us.
Mhm.
Now, we will then express that opinion to our clients if they want to move forward with it. I mean, we're not there to stop them. However, we're there to give them as much information as we possibly can.
Right.
So those holding costs primarily come from a 15% interest on a hard money loan. The hard money loan is basically a asset-based collateralized loan that uses the real estate as security for possible foreclosure or defaults on the property.
Mhm.
They will lend up to 65% of the ARV. So once we have an established after repair value, 65% of that is what we are looking for to secure both the financing of the acquisition and also the rehab. If
Mhm.
those two numbers fit within the 65% of the ARV, chances are this lender is going to say yes on the deal, regardless of what your experience or credit are.
Right. Okay. Good stuff. There's a couple things I want to break down there really quick. One is the holding cost. Like you said, that's a big number too. $22,500. That's
Yep.
nothing to sneeze at when it comes to a real estate deal. So that's based on 6 months. Basically what you're doing is you're calculating kind of what you would consider a worst case scenario where you do the deal, you put it on the market, you rehab it, you put it on the market for sale, but it sits there for 6 months for whatever reason you can't sell it. That's basically what this is here. Because you might sell it in 10 days and not have the holding costs, right? And that's just a bonus on top of your minimum profit, right?
So the holding costs are basically the financing costs that you are paying out of pocket to keep the loan on the property. So if, let's say, for example, the rehab is 65,000, just based on my experience, that rehab number is not a cosmetic rehab. There is some digging and shoveling that the client is going to have to do to get the rehab done. So
Right.
if it is a 3-month project to
I
get the
see.
rehab portion of it done,
Right.
then we're giving him 3 months to put the property on the market and
Gotcha.
sell the property. So
Okay.
yeah, that's basically $22,500 is what's going to be coming out of your pocket on a month-to-month basis that does not go towards paying off the loan. So it is very expensive money. However, it is short term and it's intended only to give you enough time to finish the project and sell it out in the retail market.
Okay. Gotcha. That makes more sense now. So that's pretty much a fixed cost there, regardless of how fast you rehab or sell the property.
Yeah, so if you can get the project done, let's say you get it done in 2 months instead of 3 months, and then 2 months later you sell the property, you are going to save on the
Okay.
22,500. Now,
Gotcha.
if you go past the 6 months, that number is going to go up.
Right.
Because obviously you've got the interest on the additional months plus the amount that it's going to take for you to get into the new term beyond the 6 months, because the lender only gives you 6 months, but they give you up to 12 to get rid of the property.
Gotcha. Okay. Makes sense. All right. So
Okay.
what's the next part of this deal?
So the other portion of it is we like to disclose to our clients exactly how much profit they're going to make on each and every single deal. In the upper right hand corner of the spreadsheet, you'll see I put in a minimum profit percentage of 10%. That 10% is 10% of the after repair value. That's kind of my own minimum threshold. If the client tells me, hey, you know what, I want to make at least $45,000 on a deal, this deal would not make any sense. So
Right.
the 10% is kind of a minimum bare standard. The profit margin on that would have to be at least 22,500. This project margin just comes in right above that, $22,643.
Okay.
So if everything goes according to plan, he's going to make 10% of the ARV as profit, take home profit, after all said and done.
Okay.
Okay.
Gotcha.
Now, some of the other things that can go wrong on a rehab project is when you put the property up for sale on the back end. What if it doesn't sell for the 22,000 or $225,000?
Right.
The sheet that section that we have in the middle kind of breaks down what the resale price is going to be and how that affects your net profit. So
Okay.
if our client had to trim his sale price $20,000 and sell it for 205,000, he would only make $5,000 in profit.
Right.
So that kind of tells him, okay, now we're done with the project. Minimum base value, I have to sell it for this amount. If I get more, we kind of try to illustrate exactly how much more he's going to make if he were to able to get into a competitive environment when it comes to selling the property on the back end.
Sure. And that would just depend on the local market at the time of selling. Right?
Exactly.
Yeah.
Right.
So the minimum he needs to really sell it for, based on the profit minimum, he needs to sell it at least for the after repair value, hopefully more.
Correct.
Yeah. Okay.
Correct.
But because it hits that minimum, this is a deal that you would recommend moving forward with to your client.
Absolutely. Yes,
Okay.
absolutely. Now, one of the other things that really tends to work out, again, if you take a look at your market in general, you know exactly the strategy that we went through last time on determine how or where to do rehabs, where to do
Right.
wholesales, where to do rentals. If you have a good grasp of where your market is and where it situates, you can develop contingency plans.
Right.
So with this particular deal, it tends to work out really, really well because, again, the client really didn't have much experience to hang his head on. However, he had a really good realtor, and the realtor was able to give us projected numbers as to what a rental scenario would look like. And so what we did is we actually took her numbers and tried to visualize or materialize those and present those to him and let him know, hey, this is what the rental scenario might look like. And, to his surprise, he had a decent opportunity to make rental income if he was not able to sell the property.
Okay.
So
That's what these numbers are here.
That's what these numbers are here.
Okay.
Here's another analysis that we can help our clients get done if it's something that they're requesting. So the after repair value, we have an increase just based off of traditional appreciation of real estate. We expect it to go up 3% every single year. Now, markets can change, economic turmoil can throw these numbers to the toilet, but
Sure.
conservatively speaking, historically speaking, real estate tends to hold and appreciate about 3% every single year. So with that being, if he were to rent this property out, this is what he would be expecting with regards to appreciation, but then also it translates directly to the rental market. So if his rental increase were to go up 3% every single year, this is what he would be expecting to collect every single month.
Okay.
Now, remember, this guy's credit was phenomenal.
Right.
So we were able to get him an analysis of what the cost would be to refinance the property.
Right.
Now we're taking a look at a whole different
after the hard money, like he's refinancing the hard money loan.
He's out of the 15%, and now he's back into a more market friendly interest rate of about 8%. Okay. So, I mean, historically speaking, that over the last few years, that's a little high, but 8% is almost half of what he was paying on the hard money. So he would be able to actually sustain this on a cash flow basis and pay the note just off of the rental income that he's
so even at the 8%, the rental exit strategy here still makes sense.
Correct.
For him.
Correct.
Gotcha.
Yep. Now, the vacancy percentage, I have 0 on this spreadsheet. That might be sticking out to a couple of people. The only reason I have 0% on here is because this property is a single family home. So once he rents it out there, I mean, it's either vacant or it's not. So he already had a potential interest in the property as a rental, because again, the realtor did a phenomenal job. So she already knew, hey, you know what? If this property were to not sell, I can probably have 3 people filling out applications for this particular property in about 2 weeks.
There's real quick, there's 2 things I want to mention there. One, the importance of having a really good team, which we talked about last week. And then also this seems to be because last time you talked about the different parts of the market that are more suitable for fix and flips and rentals and stuff. So because you ran an analysis on the rental too, this particular deal is in an area where you could probably either exit strategy would work really well, right?
Right. He is not, and I guess your particular situation as an investor is gonna play a role into determining whether or not you're even comfortable with this approach. He wasn't. Like, this was his absolute last option. The only reason is because he wasn't in the area. His 9-to-5 job kept him from basically being an effective landlord. If he got a phone call in the middle of the day saying, hey, you know what, the sink is leaking or what have you, he would be in a world of trouble. So this was his worst case scenario. He had to take into account how much of the rental income he's going to have to pay out to a management company to take that headache off of his plate. But that would then dip into his monthly reserves. So it would have been bad for him to have to rent it out, but he was still economically in a green zone where at least he won't be losing money if he had to rent it out.
Financially speaking, with regards to the deal, it's a really good deal because either exit strategy will work, and for all intents and purposes, this is a pretty good worst case scenario. In that case.
Exactly.
He might not want to rent it out, but he won't be losing money. That's
exactly.
Okay.
Exactly.
Gotcha.
Okay.
Cool. Anything else with this? With these numbers, with the rental side?
No, these are, again, these are realtor prepared numbers, and even before the realtor got us the rental analysis, again, I went on to Zillow just to do some preliminary. Again, Zillow isn't an end all be all, but at least it's a good indicator with regards to what to potentially expect. And our Zestimate on the rental market in that particular area for a property this size with this bed and bath count, it was right on the head. I think Zillow was saying it was like 1750,
Okay.
and the realtor came back saying it was like 1800. So it was right there.
With
So that
with
just
this,
gave us even more confidence to move forward with the analysis.
gotcha. Did you run like what would his net income be after financing costs and potentially a management company as well? Did you run that?
Yes, we did. The actual numbers on this weren't part of the spreadsheet, unfortunately, because I ran out of space. But he was only going to be making $75 a month on the rental analysis, on the rental aspect of it. That was after a contingency bucket of maintenance, his insurance, his management fees. He would have netted about $75 a month, which
Okay.
again
Not great.
is not great, but you're still in the black. So that's really
Right.
all we're looking for.
Yeah, you're not losing money. And again, you're not doing the deal for the rental income. This is a fix and flip deal. This is just the worst case scenario. So
Exactly.
okay, fair enough.
So
All right, cool.
this
So
is
good
yeah,
deal.
this is great when it comes to, again, knowing what you have available personally for what your borrowing capabilities are, but then also what the capabilities are, or what the market is demanding in the particular section that you're buying in. The next particular deal that we're going to take a look at worked only for flipping. um we did
So the
a
rental
rental
side was not a
analysis.
contingency.
It was not a good one. However, the numbers worked out just great when it came to actually um, doing the fix and flip.
Okay.
So, taking a look at this particular deal, this was out in Oklahoma City. We were able to secure a $60,000 purchase with a $26,000 rehab. His
Nice.
holding costs were $20,000. And that was because he had a lower credit tier. So he had to come to closing with a higher down payment. Interest rate is still 15%. But what made this deal a little bit different is that he had a private lender to come in and supplement and fill in that gap. So that gap loan amount on this spreadsheet, the
It's at the bottom left. Okay.
51,215,
Mhm.
that's the amount that the private lender came to the table with. Um, that allowed him to be able to close basically with nothing out of his pocket. And with someone being, excuse me, as a sub 600 credit score, that's a great story to be able to tell. It's just like,
Sure.
look, I got into my first real estate deal. I didn't put a single dollar out of my pocket. And if you take a look at the projection of his profit margin, it would have been $31,000.
Nice.
Now, of the 31,000, he was going to give up 25% of that as an equity split with his private lender.
Okay.
So of the 31,000, the private lender made 10,000, almost $10,500, which is almost a 21% return on investment on his part.
Nice.
So again, it's a win-win.
Sure.
We got the financing set up for the client. We got the lender fit into the equation very nicely. The project of itself was very profitable, so it worked out all the way around.
Yeah, that's good stuff.
Yeah, it's a good
He's also
it's a
got
good
a lot of
feeling to know.
He's also got a lot of cushion with regards to the profit margin minimum. He's got some cushion there with the resale price of the home, to where if for whatever reason he had to come down a little bit on the resale price, the profit margin is still there to like it still meets his minimum
Yeah,
at that
absolutely.
point. So
And
he's got flexibility
yeah,
there.
that's actually it's a really good point, because this particular private lender, he was able to negotiate. This is something that he did on his own. We weren't really involved in it. But he came to the table with the private lender. He had already negotiated with
Mm,
that individual on what his payout would be within the deal. So if the lender had come in and said, hey, you know what, I'm going to charge you 2 points, it's going to be a 15% interest on my money plus an equity stake on the back end, it probably would have been a completely different song.
Right.
But he was able to negotiate with him and tell him, hey, you know what, you'll get 25% on the back end, but there's going to be no interest
Gotcha.
that I'm
So,
going to have to be paying you on a monthly basis.
right. I got you. Yeah. This was a straight equity. Well, you had the hard money loan for funding the deal itself, but to fund the down payment, that's where it was the equity split with his own
Exactly.
lender.
Yep.
Okay.
And that comes at the back end. Once you sell the property, whatever the net profit is, the guy is going to get 25% of that. So
Gotcha.
it was a great negotiating tool on his part.
Yeah, that's a good deal. I should have asked this earlier. What is gap?
So gap is literally the spread between what the lender is willing to give you and what you need to finish the project.
Ah,
so
gotcha.
that's
I didn't know if that
literally
was like
what's
an
called
acronym
gap
for
funding.
something or.
No.
Okay.
It's literally gap funding.
Gotcha.
There are lenders that are out there that we personally don't deal with any, but there are
That was going to
lenders
be my
that are out
next
there,
question. Is if
that can
you work with
come
lenders
in and inject cash. However, if you think the hard money stuff is expensive, they're even more expensive for two reasons. Number one, sometimes the primary lender will not allow second position. So you have to know what the terms of your primary lender are.
Okay.
Number two, those individuals, the gap funders, are putting themselves at a very high risk scenario. The chances of you defaulting and walking away from a deal that you have no vested interest in is very high.
Right.
So they're going to want to capitalize on that risk. It's going to be an expensive loan.
Makes
So
sense.
again, if you don't have a good analysis on what your financial projections are on a particular deal, you could be shooting yourself in the foot for a very long time if you don't know how those numbers break down.
Right. No, that makes sense. And so, yeah, with gap funding, that would be that takes a lot of trust. So that's probably not something you're going to do with someone you've never met before, or get some kind of, I don't know, maybe there's lender networks like that do gap funding, but that would be more, maybe somebody you meet in your local area, somebody that you trust, you have experience with, or something like that is normally where you're going to get that type of funding, I would think, right?
Right. Yeah, that it's definitely more of a relationship based scenario than it is, going out and soliciting for those types
Right.
of funds.
Yeah, I got you. All right. So what are we looking at here? Is this the bad deal?
So no, this is still part of the deal that we just finished
Okay.
analyzing.
Gotcha.
However, I did want to present this to people so that they know what to expect when you get a loan disclosure. This is something you should be receiving from your broker when you sign up and agree to finance the deal with them. And this is utterly important because it shows you a lot of information that you're going to need to determine the viability of that deal. So it shows you on here what the interest rate is, what the initial loan term are, the maximum term loan, how much the purchase price is, all of that, all the way down to what your projected closing date is. The payment information, they'll show that on here, what your monthly interest only payments are going to be, plus your tax escrow. That is something that is also constantly overlooked by investors. Now, it's not going to be a make or break scenario, but when you are relatively new and you're pinching your pennies, and all of a sudden there's an extra $75, $100 that you have to pay towards escrow and make sure that your taxes are covered, it can make a big difference. It adds up really quickly.
Yeah, especially on bigger deals too.
Exactly. But on here also is the extension fee. So remember, typically they give you 6 months to finish a project. If you need an extension beyond this initial loan term, which is again disclosed on this form, you're going to have to pay 5% of the loan amount to get it to extend into the 7th through 12th month. And then again, if you need that again, it's going to be another 5% to get it to month 13 through 18. So this again is money coming out of your pocket that you are not paying anything down. You're just literally extending the loan, not paying anything down, so it can get expensive really quick.
That adds up. Better get that deal done then.
So yeah, I just wanted to show this to you so that everybody kind of, there should be no surprises when it comes to actually closing and planning to close. There's an approximate cash to close number on here. This is also very, very important. It tells you on here that it does not include your insurance premium. So if you're coming to the table and it's your first deal and you don't have the $22,000 lined up to go to closing, you've got a big problem. So that's where you've got to get creative, go out, establish the relationships you need to get a private lender involved.
Right.
Go out
that's
and get
what you
credit.
need to get the loan, right? That's what you need up front.
That's what we need to close. Yep. That's what we need to close.
To close what though? Is this at the beginning of the deal or at the end of the deal?
So this is technically at the beginning of the deal.
Okay.
So when you go to close to buy the property and actually pick up a hammer for the first time and start the development of it, this is what you need.
Got it.
To buy your rights to get into the property.
Okay.
Okay. And again, all of these fees, except for an appraisal, should be paid at closing through a title company. Everything should be handled through escrow. If anybody ever asks you to pay anything out of pocket, to wire them money directly, to pay them through Zelle or whatever, run away. It's a scam.
Yep. Makes sense. Good stuff.
So yeah, it's important for people to know what they're getting themselves into, because there are nightmare scenarios. Again, if you make a mistake on these deals, the consequences of it can be around with you for a very long time.
Sure.
So
not to mention,
what you're into.
Yeah, not to mention that. I mean, you think you're going to make $15,000 on a deal, and then you walk away with $500 because you didn't know your numbers. You didn't know about all the expenses that you don't really anticipate or plan for.
Yep. And this particular deal, the one that's up on the screen right now, is exactly the type of analysis that you don't want to do. This is literally just surface analysis that if you don't know what you're doing, you can be stepping into a big pile of dung, and you're gonna have to deal with it for a long time. So this is one of those deals that was brought to me by a realtor. The realtor did the analysis. In their eyes, they saw $265,000 worth of ARV, an acquisition price of 120, and a rehab of 70. So in their eyes, they see 190,000, which is the purchase and the rehab. You subtract 265 from that number, and that's your profit.
Right. And
when I talked to her and we actually started putting these numbers into the spreadsheet, it was a no-go. Like I don't know if you take a look at the upper right-hand corner, the projection, the profit margin, it doesn't even fill it in because it was negative. So it doesn't even want to give you the illusion that there's a profit in it. It'll just give you mumbo jumbo because that's what this deal is.
Because there's nothing to be made.
There's nothing to be made. The closing costs on it would have been $37,000. Her holding costs were $24,500.
Wow.
When I presented this back to the realtor and I told her, I was just like, you know what, this deal doesn't make any sense to your client. She fought me because she was just like, how are you possibly calculating? How is this going to cost $24,000 to hold on to? And I told her, I was just like, your client isn't in a position to be able to go out and get a 7% FHA loan because
Right.
this property is in distress. A bank is not going to approve this property. So you have to go through a hard money lender. Plus, it's going to be 15% interest. Your client doesn't have any experience. I don't have a choice but to take you to a hard money lender with 15% interest.
Right.
So it's one of those situations where unfortunately the professional in the scenario was ignorant to the investor aspect of it. Not to say she wouldn't make a great realtor when it came to residential on the market side, but from the investor side, she was not privy to the business aspect of getting into a
Right.
rehab deal.
So if the investor listened to her, sure, it's not intentional, just it's just a lack of education. The investor went through with this based on these numbers. I mean, I don't know, maybe they were able to get some kind of good financing or whatever, but you're looking at it where it would have cost the investor there if they had sold it at ARV and were close to these numbers, they would have lost over $30,000.
Exactly.
Even if they
Exactly.
sold it for $20,000 more than the ARV, which
Exactly.
I assume was accurate from according to the BOP from the realtor, you
Yeah.
still
Yeah.
would have lost $17,000 as
Exactly.
well.
Now, it's important for you to note that the the profit that we have on here is your true net profit.
Hmm.
If the investor would have gone through with the deal and they would have paid out of pocket every single month for the interest rate, they got through the rehab portion, they sold for $265,000 and went to closing, they would have walked away with cash at closing. The
Okay.
title company would have given them a check for it.
Okay.
However, that does not take into account the monthly interest that they were paying out, the utility costs that they were paying out.
I see.
That is where the net profit aspect comes in. Your accountant would
Right.
have wrung your neck because the cash to cash analysis makes absolutely no sense.
Right. So
But
you
they would have had a check at closing.
right, you would have had a check at closing, but the amount in your bank account, that would have been less than when you started the deal.
Exactly. Exactly.
That's crazy.
So yeah, it's
Crazy,
again,
man.
it's one of those where like I really wish there was a megaphone that I could
Yeah.
get on and just,
Well, that's what
try to
we're trying to make
pronounce it
here.
to people.
Yeah, that's
It's
what we're trying
it
to do here.
This Mayo formula calculation, which again we went over during the last phone call, is it's a good basis to begin negotiations when it comes to acquiring a property, but
Sure.
it is not the end all be all because it does not take into account whatsoever of what your holding costs are going to be once you get into the project.
Sure. Man, this is really good stuff. Hopefully this is a wake-up call as well that uh, and just good awareness, bringing good awareness to like how important these type one working with the right team and having access to this type of system, deal analysis system, because I mean I've been guilty of that too. Back when I was doing real estate, and I would see deals just like this example where we look at the aftermarket or the after repair value and market value and stuff. What can we acquire it for? Wow, we're able to acquire this property for like $140,000 discount. That sounds really good until you start running actual numbers here. That all of a sudden it's like, okay, well, it's not nearly as good as I thought it was, and in fact, it's actually going to cost me money. So, for me, this is I don't want to pay $17,000 to learn how to not do a real estate deal. I'd rather just learn how to not do a real estate deal and avoid the bad ones.
Exactly.
I don't want to pay
Exactly.
to have to learn how to do that.
Or actually be self-aware and understand that you may not be in the best position to make such impactful decisions without any experience. So, hey, invest in a team into
Sure.
a program that can help you analyze and actually structure your deals. Because if you are kind of flying by the seat of your pants, you're gonna get it right where the sun doesn't shine, and you'll be
Yeah.
dealing with it for a very long time.
Yeah, for sure. And when I said I didn't want to pay for it, I meant too. I don't want to lose money on a deal learning how to do it. I'd rather take that money, invest it into a mentor, into a team, and make sure that the deals get done correctly. So you're absolutely right. So that was good stuff, man. We're coming up on the 40-minute mark. Was that all the deals? Those are all the numbers that you wanted to look at and
Yeah, those
share,
are
right?
the three deals that we wanted to kind of go over. Again, we do this, we spend the time to go over these numbers with our clients on a day-to-day basis. So if you're possibly considering investing into real estate, I invite you to set up a phone call with me, or set up a phone call with one of the guys on my team, so that we can kind of walk you through and establish a budget, for lack of a better term. So that way you are fully prepared, and we can give you an idea as to what your cash to close is going to be. We
Sure.
can do that all with you on the phone first time that you call us.
Nice.
We can do an analysis, on a fake analysis on a projected property, based on just preliminary numbers. Just again, to give you an idea of what to expect, what your interest rates are going to be, what your cash to close is going to be. So that way you begin to plant the seed and see where you either need to pump the brakes and do a reconsideration, or just say, hey, you know what, this just might work out for me, and give you the confidence to put in a an offer on a property, and you've well informed, what you got ahead of you, and you can make a killing out there.
Yeah, for sure. Awesome, man. Well, as always, I really appreciate the time and the knowledge. Guys, definitely take advantage of, again, we'll have a link down in the description. Take advantage of the free call with Jose and his team, assuming that, you're really serious about doing real estate the right way. It really just boils down to the numbers, and you have to have a good team in place to help you get those numbers, review those numbers, make sure it's a good deal. You can't really put a price on that. So with that said, we'll go ahead and wrap up. Thank you so much again, Jose. That was just
Yeah, bro.
fantastic. Like I said last time, I learn something new every time we do these trainings. So I appreciate you sharing your knowledge, and I can't wait to do more of these as well. I think the deal analysis breakdown training is going to be very helpful for people. So I'm definitely looking forward to the next one. So as you get more deals, let me know, and we can break them down. I'd love to share that with people again.
Yeah,
So
absolutely. And we're actually working on a couple of creative deals, that are, we're reaching deep into our network of lenders, and we're challenging them to kind of adapt to what's happening in the economy right now. So
mhm,
we're actually right in the middle of structuring a couple of those. Once those close and we have some actual hard numbers to look at, I'd love to present those to you,
yeah,
and to our audience, and hopefully they can learn something from it. And if they can help structure another deal that's similar to that, and help prevent them coming out of pocket and getting into a really risky deal, I think everybody wins in that scenario.
absolutely. Love it. Yep. Can't wait. All right, guys. Well, we hope that you enjoyed this. Any questions or any comments, leave them down in the comments section below. Any specific requests for videos and training that you want us to do, let us know in the comments section. Really appreciate your time. And Jose, we'll talk to you soon.
Sounds good, bro.
All right, man.